Good morning. Welcome to AMRO's press briefing on the July quarterly update of the ASEAN+3 Regional Economic Outlook. I'm Daisy Wong with AMRO's communications team. Let me first introduce our speakers today. In the middle is AMRO Chief Economist, Dr. Dong He. Sitting next to him is Mr. Alan Ang. He is AMRO's Group Head for Regional Surveillance Group and Lead Economist. He is in charge of the AREO. We'll start the briefing today with some brief remarks by Dr. He and a short presentation by Alan, and then we'll take your questions. Before we move on, let me quickly remind you on the embargo. As we speak, the embargo on the AREO report has just ended at 10:30 a.m. this morning, Singapore time. And without further ado, I now invite Dr. He to say a few words on the latest outlook for us. Dr. He, please.
Thank you, Daisy. Good morning, everyone. Welcome to the July update of the region's economic outlook. So the ASEAN+3 region has remained resilient, supported by firm domestic demand and its central role in global AI supply chains. The impact of the Middle East conflict has also been less severe than initially expected. Inflationary pressures have remained broadly contained. Price increases have concentrated mainly in energy and transport. However, food inflation could rise as higher input costs and adverse weather conditions feed through to prices. The outlook remains subject to significant uncertainty. Renewed escalation in the Middle East conflict could raise energy, shipping, and food costs. The AI cycle has become a key swing factor for the outlook. Stronger than expected demand has underpinned current resilience, but even a modest slowdown could materially weaken the outlook. Heightened uncertainties underscore the importance of continued vigilance and sound macroeconomic policies. Policymakers will need to respond flexibly to differing domestic conditions and rapidly evolving external risks. A key priority is to assess and closely monitor economic-specific exposures to a potential AI-related correction across trade, investment, and financial channels, and to ensure policy readiness should the risk materialize. Thank you very much.
Okay. Thank you, Dr. He. I will now invite Alan to give us the presentation. Alan, please.
So good morning, everyone. Let me take you through the key findings of our update today. So let me begin by highlighting the key takeaways of today's AREO update. The first is that the region has actually held up better than expected. First half growth was firm, supported by domestic demand and strong AI-related exports. And the drag from the Middle East conflict has been more contained than we anticipated. Secondly, we have revised our 2026 growth up to 4.1% and capped 2027 at 4%. And inflation is projected at 1.6% for both years. Third, uncertainty remains elevated, and the most salient risks, as highlighted by Dr. He, was the Middle East conflict as well as the durability of the AI cycle. Let me take each in turn. Let me start with how the region has actually performed. Regional growth picked up to 4.4% in the first quarter of this year, and the momentum has held up through the first half of the year, even with the Middle East conflict in the background. So domestic demand has been the main driver. Consumption has been supported by steady labor markets, while investment has been supported especially by capital spending in advanced manufacturing and digital services. Net exports have added further to growth. Now, what is notable is that this strength has been relatively broad-based across the region. All five economies that have reported second quarter GDP grew firmly, and the early indicators for the rest of the region point in the same direction. On inflation has stayed broadly contained. Headline and core inflation both picked up at the onset of the conflict in the Middle East, and they have since moderated, tracking commodity prices down from their peak. That said, commodity prices are still above where they were before the conflict began. The area that we are watching very closely is on food. Here we expect some further upward pressure as higher fertilizer and transport costs feed through, and with the adverse weather adding to this. Now, let me spend a little more time on AI because AI-related demand has been central to the region's performance this year and is also one of the key factors that will shape the outlook ahead. So, the region sits at the center of AI production globally. ASEAN+3 accounts for about half of global AI-related trade, and that covers raw material, intermediate inputs, and equipment. And the region's exposure, in fact, it's runs a bit deeper than this number suggests because it does not capture non-trade exposure such as investment in data centers. Now, the contribution to growth has been significant. In the first quarter, AI-related products accounted for close to 2/3 of the region's total export growth, up from about half in 2025. Demand also looks set to hold up. Forecasts for global semiconductor sales growth this year have been revised up repeatedly from 10% last August to 26% in December last year to up to 90% now in the most recent forecast period. Now, this brings me to the latest forecast. We have revised regional growth for this year up to 4.1% from 4% in our previous ARIO update in June. And we have capped next year at 4%. Now, this compares to 4.3% performance in 2025. Now, this upgrade is especially concentrated in the economies that are well integrated into the global technology value chains, and it also reflects the lower commodity prices assumption that we have now. On inflation, we have revised this year down to 1.6% from 1.8% previously, mainly on account of the lower projected energy prices. For next year, we also project inflation to be at 1.6%. Now, let me turn to the risks. As I said earlier, the two most salient ones are the Middle East conflict and the durability of the AI cycle, and I will take each of them on the next two slides. But before that, let me address the new US tariff measures announced last Friday. Now, this came after our cutoff date and not in the projections, but let me offer a few observations. Now, the measures largely replace the 10% surcharge that has expired rather than sitting on top of it. So this means that the immediate increase in trade costs is smaller than the headline rates suggest. Our preliminary estimates is that they would raise the region's effective tariff rates by less than a percentage point, although the impact will vary across economies and sector. Uncertainty around this remains high as other investigations are still ongoing. So what gives us some comfort is that the region has so far absorbed successive trade measures with limited disruptions. Domestic demand has been resilient. Export markets are now more diversified, and our firms have to date been able to adapt their sourcing and production. We will, of course, continue to monitor the situation closely. Now, on the Middle East conflict, our baseline path for crude oil is now about $10 lower than in what we assume in our June interim update at around $80 a barrel for this year and around $70 next year. Now, that's close to what the current future curve is at now. This reflects the US-Iran agreement, though prices have since rebounded somewhat, given that tension has resurfaced. In our baseline, crude prices normalize gradually through the second half of this year. Given how uncertain the situation remains, we have also run an adverse case in which the disruption persists through 2027 and Brent holds at around $90 to $100 per barrel. Now, in this scenario, regional growth in 2027 will be 1.2 percentage point below our baseline, and inflation would be about 3 percentage points higher. Now, let me turn to the AI cycle, which as I have mentioned earlier, has become a key factor influencing the outlook for the region. Now, our baseline has global technology investment continuing to expand through 2026 and then moderating in 2027. Now, this is broadly in line with current industry expectations for the global semiconductor cycle. As with the Middle East scenario, things are highly uncertain. So we have also run scenarios around this baseline. We have considered an adverse scenarios which assumes that global investment grows at a slower rate, at a rate that is similar to the pace that we saw in 2024. Now, in this scenario, regional growth in 2027 will be about 1.5 percentage points lower than the baseline at around 2.5%. That will be the weakest growth for this region since the Asian financial crisis outside the pandemic year. And I will emphasize that this scenario does not assume a sharp correction. It only assumes that investment continue to grow, but at a pace that is slightly slower, that is the pace of 2024. And if this is accompanied by a disorderly correction in financial markets, which we have not explicitly modeled here, the outcome could be considerably more severe because the effect would be amplified through financial channels. So let me close with 2 points. This is a better update than the one we released in June. We are projecting growth of 4.1% for this year and 4% next year, with inflation at 1.6% in both years. Now that is a solid outcome for a year that has tested the region. At the same time, the upgrade is fairly narrowly sourced. The AI cycle is doing much of the lifting. And that is what we will be watching most closely in the months ahead, alongside the other risks that I have flagged this morning. Thank you.
Okay. Thank you, Dr. He and Alan. We have received questions from some of you in advance, and let me begin with some of them first. And please feel free to continue to send us questions in the web chat box. I think I'll start with a question from Yitai of China, and then we'll go to another fresh question from The Edge on US tariffs. The question from Yitai of China, the outlook for shipping resumption through the Strait of Hormuz remains dynamic. Is the resulting import cost shock triggering second-round effects across the region, leading to more sticky inflation? That's the question from Yitai.
Okay, let me take this question. Thank you for the question. As you can see from the news headlines, certainly the situation in the Middle East is still in a very uncertain state. I think the traffic through the Strait of Hormuz, of course, varies depending on the security situation. So we will. I think the safe thing to say is that we'll see continued volatility in oil prices. Having said that, as you can observe from the in the past several months, really the second round impact is very contained. We haven't really seen broad-based second round effect on inflation. So the impact has been primarily on energy and transportation cost. Now, I do worry a little bit about the food prices, food price inflation, since that petrochemical prices will affect certainly fertilizers, and that would affect food prices. But so far, we haven't seen broad-based second-round inflation, and core inflation in the region has really only modestly increased. Now, having said that, as Alan mentioned, that we do have different scenarios. If in our baseline scenario, we assume a range from averaging about $80. So that is our baseline. But if it goes up by another $10-15, then that would of course affect the region's growth, particularly in 2027, quite significantly. We have already gone through more than half of 2026 now, so I think the outlook is primarily thinking about what would happen to 2027. So in that kind of adverse scenario, ASEAN+3 growth would slow to 2.8%, while inflation could rise to 4.6%. So that's the adverse scenario. Now, we also should emphasize the impact would differ across economies. Economies such as Japan, Korea, Thailand, and the Philippines are more exposed through either higher energy import dependence and energy-intensive manufacturing, Malaysia and Indonesia may benefit from stronger commodity prices. They would still face higher transportation cost, weaker external demand that's on the secondary indirect impact, and potentially financial market volatility as well. So it's quite a heterogeneous picture. But overall, we think so far the impact of the Middle East conflict in our region has been contained. Inflation certainly is going to be higher this year in 2026 than 2025, but growth is holding up pretty well. Thank you.
Thank you, Dr. He. We have a couple fresh questions in the WebEx chat box from the Edge of Malaysia on US tariffs and then a potential AI slowdown. Let us read the first one. Let me read the first one. Would there be any revisions to the forecast for ASEAN and ASEAN+3 amid Trump's refreshed wave of tariffs announced last Friday? That's a question on the tariffs. Will there be any revisions of our forecast for ASEAN and ASEAN+3 following the US tariff announcement last Friday?
No, there won't be any revisions because, as Alan has just explained, the new tariffs are similar to the import surcharges that expired on Friday. So the impact or the tariff rates would not be raised more than just about 1 percentage point as compared to what expired on Friday. So that would not materially affect our forecast. But of course, the tariff policy of the US administration is subject to quite a lot of uncertainty. There might be new tariff rates along the way, but based on what's been announced so far, we don't see any material impact.
Okay.
Thank you.
Before I go to the AI question, there's a related question from the Business Times in Singapore. It wants to ask, Singapore is facing higher US tariff rates than regional peers. What direct and indirect repercussions could this have on Singapore's economy and trade flows? Is the US tariffs impact on Singapore's economy and trade flows?
I am not sure what you mean by Singapore is facing higher tariffs than its peers. But having said that, Singapore is an advanced manufacturing-based economy, has different export structures from other regional peers. So they are not in a direct competition position. Singapore has very high-end manufacturing in pharmaceuticals, in AI conductors, AI-related exports. As you can see, Singapore's growth has been revised up significantly, and we don't expect that would be affected by the new tariff rates. Thank you.
If I can add on this, is that the thing, the point we try to emphasize is that the current new tariff is actually in a way similar to what we have faced before in the import surcharge. So this is not on top of what we had before. The import surcharge has expired and has been replaced with this. Now, the case for Singapore is also important for us to remember that there is still a lot of assumptions in the current tariffs that includes electronic components and so on. So from our estimates is that only about 30% of Singapore's export will be affected by the tariff. And in fact, if you look at effective tariff rates, Singapore is not one of the highest country in the region which will face the tariff from the US. In fact, it's one of the lower ones. So in that sense, I do not think that the current situation will be that severe for Singapore. In fact, there's not much change in the effective tariff rates.
Okay, thank you. Let me go into the question about a potential AI slowdown. Again, this question is from the Edge newspaper of Malaysia. What factors are going into the overview of a potential AI slowdown and how plausible is the slowdown demand for the rest of 2026? So it asks us about the factors about a potential AI slowdown.
So let me start, and Alan can supplement. So certainly we are not predicting a moderation in the AI related investment exports. To the contrary, we have said these are two-sided risks. There could be even an upside in the momentum, but what we would be worried is a potential downside, but we're not putting any probability of that correction. What we have understood from our dialogues with the industry, many of the manufacturing sectors have contracts that are already fully booked. Their capacity is going to be full until a year later, well into 2027. So this momentum is likely to continue. On the other hand, you have seen that the financial market has been quite volatile, particularly on AI-related firms, their stocks. We cannot rule out the possibility that earnings may disappoint at some point, and there could be sustained correction in financial markets, and that could lead to some moderation in the AI-related products sales. Now, the reason why we highlight the region exposure to this is that the region, unlike many other parts of the world, is really at the heart of the global AI cycle, AI boom, because our trade account for 50%, more than 50% if we count Taiwan province of China, and that's almost 60% of the world's trade in AI-related products. And AI-related exports contribute to more than 2/3 of our export growth in the recent quarters. So that's a good thing, but that also means that if there is some correction, then the current growth momentum would be affected. So that's the kind of scenario we have to be aware of, and the impact could be quite significant. That's why we emphasize that it's important for the economists to watch for potential exposures and how a potential correction might affect the financial systems, export growth, economic outlook, all and the necessary policy response that we should put in place. Alan, any additional comments?
That is already very comprehensive.
Right. Okay, thank you.
Okay, thank you very much. There's one more question on ASEAN region. It's a fresh question. Before we go into the country-specific questions, this one is from Malaya. What factors contributed to your assessment of an uneven growth for Southeast Asia in the latest report? So a question on an uneven growth for Southeast Asia in the latest report.
Right. That's a very good question. Actually, if you look at this forecast table, the green ones, that means where we have raised our growth forecast, are the economies that are very much related to the AI boom, right? Korea, Malaysia, Vietnam, Singapore, and to some extent Thailand as well. Thailand has seen strong private growth in data centers and all this. So I think that's a sign that the unevenness of the growth. These economies are more plugged into the AI supply chain, so they are benefiting from the stronger momentum. In some other economies, I think they are hit a little harder by the import bills of higher energy because of higher energy prices. There are a bit more specific country-specific factors at work. For example, the Philippines, Cambodia, and a few others. You can see their growth a little slower, or quite a bit slower than 2025. So these are some of the country-specific factors we could touch upon a bit later. But overall, I think at the moment, the unevenness is a reflection of the degree, the different economic structures, particularly or specifically how they are plugged into the AI supply chain. I don't know whether Alan has any additional thoughts.
I think another point is that while growth rates do differ, I think directionally they are in the same direction, in the sense that we are seeing stronger growth for this year compared to the stronger growth next year compared to this year, and also growth is actually slower compared to the year before. I think that reflects the confluence of the factors that's affecting the region.
Okay. We got quite a lot of questions. We'll try to address them as many as possible. Now, let's go into Vietnam and Cambodia. There's a question on how confident are you that Vietnam's GDP forecast would not compromise price stability?
Alan, would you like to take that?
So we have, as you can see here, we have revised the growth forecast for Vietnam upwards to 7.4% for this year and 7.3% next year. I think this forecast at this growth rate is actually broadly in line with Vietnam's potential trend growth as estimated by AMRO staff. So in that case, given the situation, given that it's close to potential, we do not expect it to actually exert significant inflationary pressure. So we do not expect at the growth rate of such they will actually compromise price stability. But of course, there is uncertainty surrounding the outlook, especially when it comes to inflation, especially if there is a renewed tension in the Middle East that could actually intensify, further add to inflationary pressure. So I think maintaining prudent monetary policy and ensuring credit growth is aligned with the economic fundamentals will be important safeguard to price stability.
We have a few questions from journalists in Cambodia. Cambodia has one of the region's highest inflation forecasts this year, while the IMF recently downgraded its growth outlook. How does AMRO assess Cambodia's economic outlook?
So let me take that one. Thank you for the question. So Cambodia, the inflation, I think, is a little higher than others. It's primarily driven by food prices. So, in Cambodia, food prices account for about 45% of CPI basket. So food inflation has surged over the past year due to both the oil price shock and supply chain reconfiguration following the border conflict. Of course, this is a bit more specific to the country. Before the conflict, around 80% of the total food imports came from Thailand. So now there's some reconfiguration of food import supply. And we expect food prices to stay elevated in the second half of the year due to volatile commodity prices and the impact of the border conflict. But overall inflation, we expect that to moderate in the second half of 2026 as the oil price shock eases and the government's ongoing measures, including fuel subsidies, help contain price pressures, partially offsetting elevated food prices. So in terms of growth, we can't comment on the IMF's forecast, but our forecast is higher at 4.2%. That's about 1 percentage point lower than 2025, but it's still a pretty, I think, solid growth rate. And in general, I think our view on the outlook, on growth outlook in Cambodia is cautiously optimistic. Cambodia has seen continued strong export growth, even in terms of non-garment exports, such as electronics, furniture, and some other processed agricultural products like cashew nuts. These have seen very strong growth, and of course a strong FDI. Cambodia continues to attract very strong FDI. So we are quite confident with this cautious outlook, growing at 4.2% this year. But of course, there are important downside risks, particularly related to the external environment. Tourism continues to face headwinds. But more broadly, Cambodia's macroeconomic fundamentals remain broadly sound. I think what we would like to see is decisive actions in, for example, maintaining financial stability, in containing the non-performing loans in the banking sector. I think the government is taking actions in those fronts. But with this, prudent macroeconomic policy and the financial policies, we think, Cambodia can deal with these headwinds reasonably well. Right. Thank you.
Thank you, Dr. He. Let's move to Malaysia. We have several similar questions from the Malaysian press, Berita Harian, Sinchil, and LTM. Malaysia's economy recorded solid growth in the first half of 2026. Can you explain the reason for the upward revision and what will be the key drivers of growth?
Yes, indeed. We have revised our growth for Malaysia for 2026 to 4.9%. And this is really on account of the stronger than expected performance in the first half of this year, especially in exports and in investment. So we have upgraded growth for the remaining of the year on continued strength in the AI-driven exports, as well as in sustained investment, especially in data center, and also a rebound in LNG production, actually, specifically for Malaysia. We do expect growth to moderate very slightly in the second half of this year on weaker domestic-oriented manufacturing. But we expect continued strength in export-oriented E&E especially. But I would like to reiterate that the outlook continues to remain positive for Malaysia.
Okay. One more question on Malaysia, also from Berita Harian. The ringgit has been one of the best performing Asian currencies this year. Do you remain optimistic about its outlook for the rest of 2026? What factors could support or challenge its performance?
I think the ringgit's performance will continue to be influenced by both external and domestic factors. This includes U.S. monetary policy, global risk sentiments, and also, of course, Malaysia's economic fundamentals. I think Malaysia's stronger growth outlook, sustained investment inflows, and healthy external positions should provide underlying support for the ringgit. But that said, short-term volatility is likely to persist given the ongoing uncertainty in the Middle East, for example, and also uncertainty surrounding monetary policy in the US and also US tariff policies. So, yeah.
Thank you. We got quite a number of Philippine press with us today. Okay, we have quickly summarized their questions, and they generally want to know, how does AMRO assess the outlook for the Philippines?
Right. Let me take that one. I think thank you for your interest, continued interest from the press in the Philippines, in AMRO's views. On the Philippines, Philippines is one of the countries in the region that has been harder hit by the oil shock so far, and that's reflected in both the lower sort of growth rates we forecast for the Philippines this year than last year, but also the significantly higher inflation than 2025. As you know, that the pass-through from energy prices to consumer prices in inflation in the Philippines was quite fast, and that to some extent reflect the limited fiscal measures that the government took. I think this is a reflection of the prudent fiscal policy stance the government has taken, but it does get reflected in higher headline inflation. But the central bank also acted very swiftly in tightening monetary policy. So that has helped contain the broader pressures. And indeed, as you know, because oil prices now, we're assuming in the baseline a lower level, so we would expect that overall inflation in 2026 for the Philippines would be slightly lower than we thought would be the case back in June. As you can see, it's now 5.7 versus 6%, but it is quite a significant jump as compared to 2025. On the growth front, it continues to benefit from the AI cycle. Actually, the Philippines, even though we typically think that the Philippines is very much a service-based export economy, it is very much plugged into the global AI cycle as well. You know, they are very involved in the semiconductor exports, so that would continue to provide support to the export growth in the Philippines. Now, I think what the Philippines outlook, this somewhat slower growth in 2026 as compared to 2025, is also a reflection of the weaker or subdued private investment. I think for the longer term, medium term future, I think this is an area that the Philippines should really focus on. That is how to strengthen private investment so that the production capacity and the infrastructure will be strong enough to support higher medium-term growth in terms of dealing with, for example, extreme weather conditions, to make the Philippines economy much more robust against these, for example, the natural disasters. And so some of the governance issues relating to infrastructure investment will have to be resolved. But overall, I think the Philippines economy, I think again is benefiting from the AI cycle, but it has some specifics in terms of its oil exposures to the Middle East. It's probably lack of strategic reserves in terms of oil supply. That's reflected in these numbers. But overall, I think it's a pretty we are again have reasons to be reasonably cautiously optimistic on the Philippines as well. Thank you.
Thank you, Dr. He. Before we close the briefing, let's take one last question on this follow-up question from the business world and Philippine Star. It's a follow-up question on growth outlook. I think it also applies to other countries. They want to ask how significant of a risk does the looming El Nino season and the U.S. tariffs pose on your growth outlook, especially Philippines. So El Nino and the U.S. tariffs.
So let me take that question. I think on the tariffs, as I mentioned already, we don't expect a major change in the way how we think about the uncertainties of the U.S. tariffs on the region. Broadly speaking, I think the region really has adjusted very well to the uncertainties imposed by the U.S. tariffs in the past more than 1 year since the reciprocal tariffs started in April 2025. The private sectors have adjusted or reconfigured their supply chains. So, I think the region has, dealt with tariff-related uncertainties quite well. We don't see any further change in our view on that. On the El Nino, this is highly uncertain. We do pay, as I mentioned, I do worry that food prices can be significantly affected by extreme weather conditions. But it's highly uncertain. Experts, we rely on experts' views on the likelihood of, extreme weathers. It's hard to forecast. And some experts take the view that El Nino's impact could be more visible in 2027 rather than 2026. So all these factors are quite uncertain, but I would say, there is an important upside risk to food price inflation in the region, and we should be very well aware of that. And as you know, food prices take up a significant share in the CPI basket. As I mentioned, in Cambodia, it's 45% of CPI basket. So I think this is an area we have to be very vigilant about, and but it's really hard to come up with scenarios to pin down the effects of El Nino. Let me stop there. Thank you.
Okay. All right then. Okay. Thank you all for your interest in AMRO's ARIO report, and we'll conclude today's press briefing. For more details, you may make use of the QR code on this screen to download the ARIO report. And thanks again for joining us today. We hope to see you again soon. Thank you very much.
Thank you.
Thank you.